importantly, we saw the markets, the Dow rallying to the closing bells up over 500 points. This is, of course, after the Democrats won back the House of Representatives, Republicans holding on to the Senate, and in fact gaining in their footprint there. So let's talk a little bit about what this might mean for your portfolio, your money. We've been doing it, but right now we've got Kevin Mcreadie coming in. He's the president and chief investment officer of AGF Investments. Kevin, great to see you. Thanks for rounding out the show and the program today.
Thanks, Catherine.
Let me first get your take in terms of what we did see and what you think it means for the markets. Obviously, they liked it today. Is that going to be the case tomorrow?
Well, I think you removed a large uncertainty today of two extreme outcomes. In either case would have been tougher for the markets to digest.
Okay.
If you take the red sweep version, it means more fiscal policy, maybe a new tax cut, right? Things that the bond market may reject with a pretty hot economy, right? And then you look at other things that they try to do potentially with trying to reform Obamacare again, things. So those are over there now, gone. And then you take the blue sweep, which it didn't really happen to that great degree, which would have been also probably negative for the markets, unwinding some of the fiscal stimulus. So in some ways, you got to a Goldilocks kind of place with this outcome, which I think is what you're seeing. And I also think the fact that the markets have come through a pretty tough patch in October left them probably a little bit oversold, that gave you a reason to have a bit more bounce today. So tomorrow, I think we're going to be back to grind it out with the news cycle, and people start looking forward what happens next.
So during commercial break, you said to me that, well, now we're in a new news cycle. Hard to believe. What is that new news cycle, Kevin?
You know, if you sat here 2 years ago when he was elected, and we all thought, the guys on your side of the table, guys on our end of the business, thought that we would all get used to the tweets of the moment, right? And 2 years later, we haven't. It is still moving markets and things of that nature. And now you've got a new protagonist in this, right? Which is the Democrats controlling lawmaking in the House. That's where laws are started. So while nothing may get done, the rhetoric is probably going to get ratcheted up a bit around certain things.
Which is interesting because, you know, there is the view and, of course, the hope, I think, amongst many that they will actually work together. But when we heard the press conference today, I mean, what is your takeaway in terms of whether or not they will actually move in that direction?
I think day one, the rhetoric around things such as impeachment and subpoenas wasn't really there. But you go to the Democratic base and listen, it is real in terms of the anti-Trump view, right? And even though 2 years ago you proved that Hillary Clinton ran on anything but Trump and didn't win, I think there's still a large left-leaning, stronger left-leaning base in the Democratic Party that wants to see that agenda pushed. So I don't think that he is going to be able to work closely with them.
Okay.
There was a headline today that said that he thought he could do better with the Democratic Congress than his own party, which is a little shocking, but so we'll see. But hard to see it.
Okay, so it sounds like pretty tough gridlock and tweets to accompany that gridlock. So that's what we should be expecting. What does that mean then in terms of some of the policies that you think will be put in play or not? And I think for me, the biggest one, and I think for the markets certainly, and the corporations in America, has been China-U.S. trade relations. What would you expect there, and is that your focus?
Well, you know, if you had the red sweep, right, where they're emboldened, the Republican Party wins both, keeps the House and the Senate, it's probably a strong signal to the world that he's not going to back down. I equally, if they had a blue sweep, I think he's a very weakened president and probably cuts very easy or minimal deals. I think what you have now is a president that can't push a fiscal agenda forward, and he's on the back of higher rates coming. The economy is pretty red hot in the U.S. right now, so I don't think the Fed is stopping anytime soon. So he needs a decent economy and therefore a decent stock market if he wants to run this thing for the next 2 years into that re-election cycle. If you think about tariffs, right, the tariff noise has been painful for the market. So you listen to company reports this quarter, you can rattle them off by industry, and everyone is not talking just about labor, they're not talking just about finance costs, they're talking about now the impact on their supply chain of higher tariffs seeping in, and whether it be aluminum or steel or even intermediary goods coming again in the side of the supply chain. So I think that probably softens the tariff noise if you believe he needs a decent economy and therefore a decent market.
So do you think then that he, on his own presidential executive power, can come to a conclusion with China, or because of the Democrats winning the House, what will they have to say in terms of saying, well, wait a second, we're not so sure here because we also believe that China has been part of patent infringements in our technology?
Yeah, I think there is agreement, the fact that it's not just the Republicans, it's not just Trump, it's the Democrats who do believe China needs some reform on trade and tariff, right? And the question is, they also don't want to see a trade war. If you look at the states in the Rust Belt that are affected by some of this, right? What got Trump elected 2 years ago were Wisconsin, Michigan, Pennsylvania, right? Which no one would have thought. They turned, right? And so there's some pain there, I think, that people are worried about with this trade war. And so I suspect that the Democrats go along with something moderate. But I do think that, we have some key dates out there on trade. You had this November 30th meeting of the G20, where the meeting with the Chinese Prime Minister is going to occur. And so I think that gives you some hope that can they start talking? And that may be a good positive tailwind for the market, which is already in a pretty seasonally good place. November and December have been historically decent months.
And Kevin, everybody seems to be in agreement right now that the next 2 months could look quite good for investors. But what happens in 2019? How do you see the markets playing out? What are you thinking about, and how would you be positioning portfolios today?
I think the U.S. economy has been red hot. I mean, you look at a 3.7% unemployment rate. You're starting to see wage inflation. The wage numbers last week, 3.1%. So you have to start to worry about how much better can it get. And you're going to have this tug of war between equities and the Fed saying, are they going too fast? Are they slowing things? And slowing things means slower sales, slower profits potentially. And you throw the tariff thing on there. So the markets are going to have to get into January with some of this, how hot versus how tight. I think the second things you're going to see that will pop up are going to be things that are going to be related to this gridlock. You have to deal with this debt ceiling come February 4th, which means you need to start the budget discussion. I just don't think there's a willingness to bend. So you're going to compound, which is already a classical tightening cycle, and its impact on equities with these other pieces of noise. So I think you're going to be in a little bit of chop. We think the equity markets in the U.S. grind higher. And we think fixed income, obviously, is going to be a place where you need to be a little cautious here. We don't think rates, long rates run too far out there, but you're going to see some pressure on the front end of the curve a bit here.
Okay. What does that mean, though, in terms of geographic exposure? If you're invested in equities, and what about Canada? I mean, we're down 5% year to date. It's been a huge underperformer for a number of years. At what point will we see Canada as actually an opportunity, a value opportunity?
Yeah, we're overweight the U.S. For now. I think it's been the right call. The second piece of that is we're overweight now emerging markets. And we think the dollar is in a more stable path here, that big dollar move we had. And I think if you believe that this trade thing with China doesn't get into a Cold War, and you can get to a moderate resolution sometime in late 19, the emerging market story is pretty valid.
Okay.
Valuations look great, growth rates look great. Assume you keep China in a stable path. And then lastly, I'd say on the Canada trade, Canada looks cheap. It has underperformed so dramatically here, right? You take back only 1 year in this last 5 where it's outperformed, which was on the back of that potential rebound in oil after 14 and gold. It's really been a tough place. But you also don't have the growth sectors represented in Canada the way you do in other places. So technology's such a small representation. Healthcare, where you get a higher multiple.
Yeah.
So when you look at the aggregate, it looks cheaper than it may be. And unless you get energy moving, I think it's going to be a harder story.
One last question here, though, because, yes, we're looking at the TSX, and I asked you the question from an aggregate perspective, but I do think, and it seems as though we're in much more of a stock pickers environment, and really have been for the past 2 years or so. Is that still the case in Canada? In other words, don't just look at the TSX or the TSX energy sector, financial sector, but pick those companies that have been underperformers, and is there value there, is my question.
I think there is in certain sectors. You're starting to see the banks underperform. So, and that's such a large representation in the aggregate index, so I think you're absolutely right. Strip those out, there are probably very individual companies that are getting tarred pretty heavily with a broader brush around a sector theme. So I do think it's a better stock picking environment in Canada today than it's been.
Okay, Kim, we've got to leave it there. Thank you. Nice to see you.
Thanks, Catherine.
Thanks. That's Kevin Mcreadie, President and Chief Investment Officer at AGF Investments. Coming up next, we're going to have